Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Wednesday, the 15th of February, Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. We'll go through our usual regular run through in here today, calendar, what we've had, what we've got coming up, focusing on the CPI data for yesterday initially. Look at the articles from the major news wires. What are the macroeconomic, fundamental, geopolitical events that are shaping markets right here, right now? And then we'll take a look at the charts to see how those events, the data, etc., that we've had has impacted onto the charts. Where are the potential trigger points? Where are the opportunities on the major markets that you guys are trading going into today? Okay, let's take a look. So looking back, first of all, CPI. Okay, so been focusing on the big moves that we've had. Just going to the S&P here, say daily. We look here. This is September, massive move, big turnaround rebound back in October, huge, nearly 6% up day in November, big-ish down day in December, and then muted in January, choppy, and then again very choppy. Long-legged doji yesterday, a classic sign of indecision. Given that we've got the topping pattern already gone in, if you read my daily market report in here, you'll see we're kind of hanging on to a bearishness. On a short-term view, on a day trade view, hanging on to bearishness because of the failure yesterday. It fell right at a resistance point, came back lower, chopped then down and back up again in here on the overnight. So the market very, very indecisive. Reluctant to take out this trend line, by the way, the shallower trend line that comes from the beginning of the year. Okay, and if we look at the equivalent on the Nasdaq, the market's holding right at that same trend line. Held at it at the end of last week, beginning of this week, and then rebounded from it yesterday. So, the market really kind of showing some indecision in here. Go back to in here, go back. We've got that topping pattern that built. We said that quadruple top. This is on the Nasdaq. The quadruple top on the market breaking down through that low there, right? Through this low here. Yeah, through this support in here, but now back above that area, and chopping, back up in here in the last, 15, 30 minutes or so. Similar story if you go in on the 15-minute, you got this topping pattern here from over here, okay, on the S&P, topping pattern. Okay, got confirmed down through there, then hasn't really built on that, and then yesterday back up, chopped, but then failed, look, bang, right at that resistance point, that high there, just fell from below it when we chopped higher yesterday, and it was super choppy yesterday. So, but, and then overnight we kind of sold off, and then we've rebounded. So the market's kind of really still continuing, even on the overnight, echoing that kind of indecision. And there is a lot of indecision in there. If you look at my reports on the daily, kind of hanging on, but it's like hanging on to a bearishness from that topping pattern, from the topping pattern that we have over here. Okay, from this topping pattern, it's hanging on to a bearishness, but that could quite easily flip in here going into today. So it's kind of making mind update, today. Are we more concerned about the fact that inflation is slightly higher, there's potential higher peaking rate, and I'll go through all that now. Let's have a talk about all of that. So if we go back to the data, so the data was, yes, it was higher, but how much higher? The market basically wanted the market to beat, right? It wanted it to beat, to go higher. We're coming in at, and I do think there's an element now that markets to some extent have got to the point now of pricing in. They're pricing in where the Fed, they're pretty much pricing in where the Fed are telling us. They're a little bit ahead of themselves on the rate cut. They think we're going to potentially dip into recession. The Fed will be forced to cut into the end of the year. And we'll look at the dot plot, not the dot plot chart. We actually would look at the dot plot chart, but we'll look at the curve, the CME Fed tool in here, and see where the market's pricing in. But I think what we're seeing in it now, we've got to the point where if we'd had a really strong print yesterday, okay, if it was, if the number is particularly high, and it was obviously above expectations, so the market doesn't like it, doesn't really know what to do with it, but it doesn't like it because it means the Fed are going to be potentially more hawkish, right, on rates. And the curve, the Fed curve, and the movement in treasuries tells you that, right? And we'll take a look at that shortly. However, if we look at the equity markets, they're undecided because higher rates, but does this mean we're going to maybe stave off recession? And there, from the strong jobs data we had last week or 2 weeks ago, there's some real indecision in there. But if the market had been weaker than expected, if this data had, if we printed down, I don't know, closer to 5% on the core and 6% on the headline number, then the market probably would have said, well, the Fed's going to be more hawkish. They've got room to move higher in rates because we've got it's coming under control. Does that send the Fed even to a more hawkish position? Or does it mean the Fed won't have to cut? And so I think the stock markets at the moment have got to the point where kind of damned if you do, damned if you don't. Either a strong or a weak piece of data, and the fact that it's coming in line just shows you we've got the choppiness. I think near in line is probably the best that the market, as in when I'm saying the market here, I'm talking the stock market, the equity markets could hope for, because I think a stronger print would certainly see a more hawkish Fed. And if we started to see inflation coming under control, okay, and then it gives the Fed maybe a little bit more room, kind of stuff. If it starts to come under, they're not going to be cutting anytime soon, but it doesn't necessarily mean that would have been a huge positive for the market either if we're seeing a better print than expected. So I think the market's a little bit confused in here at the moment, how to react to the data. And it certainly showed that with the choppiness that we saw through the data, right? We went up and down like a yo-yo through the session. Then, relatively strong close, having had weakness at one point, and then, lower overnight, and then rebounded, as we're going as we get closer to the US waking up. So some real indecision in there at the moment. And then we had Harker and Williams last night. Didn't help matter, right, on the wires. And it wasn't just Harker. It was Harker, Williams, and someone else as well. Barkin, was it? I'm not quite sure. But so rate debate, here we have. Yeah, Harker. Who did I just say was on the calendar? Harker and Williams. Yeah, Harker and Williams. Maybe it was just Harker and Williams. But basically, Logan as well. And Barkin, it was Barkin as well, and Williams. So we had all of those speaking, right? Bloomberg TV that so Barkin, if inflation persists at levels well above our target, maybe we'll have to do more. Yeah, hawkish, right? Laurie Logan flagged the need to remain prepared to continue rate increases for a longer period than previously anticipated. Higher for longer. So we've got higher, we've got longer, and then Harker says he believes policymakers will need to raise interest rates above 5% and possibly higher. Okay, well, 5.1, I've got the dot plot chart in here. Now, I can't find it. I think it's because, as far as I can remember here, they don't put the dot plot chart out after every single meeting. And I think the last one that I can find is from the December meeting. I can't find one from the February meeting. But, the level is 5.1. And then this is, if you look at the dot plot chart, there's the consensus is around 5.1 in here, okay, for the end of 23. Okay, so end of 23, we've got 5.1, and that's what the curve's pricing in, right? If I go to the CME curve in here, we've got the market going up. So at the moment, we've got a nailed on pretty much for the next meeting in March 25. Then we go for the May meeting. We've got another 25. Okay, that takes up to the 500 to 525. So that's where the Fed, anyway, is kind of pricing us in. Actually, no, sorry, we'll go up to 500 to 525. So that's 50 up, right? Up to 50 up. And then we go to the June meeting now, though. That's what the Fed are already telling us on the last dot plot chart. But that was from December. Had a lot of data since then. But the Fed is trying to ratchet that up. And now we've got 525 to 550. So the market is now pricing in more than the Fed is told us in the last dot plot, right? But then the Fed, in those statements there that I've just read out to you, the Fed are starting to tell us, it's going to be 5% and above. We're not going to stop at 5.1 where the consensus was previously, but the market's already started to price that in. So we're now pricing in, okay, by June. So three hikes at the next three meetings, right? We were here previously, right? If I go and look in here for June, okay, and if I go look at the historical for June and get rid of all of these, this frustrates the hell out of me that you have to do this. Why you can't just untick them? I don't know, but you can't. So here we go. If we go and look at the two in here for the 500 and the 525. So 500 to 525, we're going to be at least that, right? But look at the way this is shot up, the 525 to 550. Okay, basically we have zero chance of 525 to 550. It was hardly anything. Down here, at the end of January, we were sitting at 3.4%, hardly any chance of going that high. Then we had the payroll data. Okay, and then since the payroll data, we saw a leap, and then post-payroll, a leap, and then another leap. So we're now nailing on. We've now got, where are we now? We are 50 over 50%. Okay, chance now for the June meeting of us now having up to the 525 to 550 region, which is up 325s, 25, 25, 25 from where we are now. So again, the market's starting to nail on. Okay, 325s. Okay, let's just go back to the current. And then we go out through July, staying at 525, 550, certainly up to there by July, and then 525 by 50, September, November. What the market's not listening to is the Fed saying, look, here we're at 500, 525, so back down, only 50 up from where we are now. So looking for a rate cut by the end of the year. That's what they're not listening to. And that's because the market still believes we're going into, there's risk of, recession and a slowdown, and the Fed will be cutting quicker. Okay, the Fed are telling us they're not probably going to be doing that. Higher for longer is the mantra. Okay, we've seen since the last two pieces of data, since the employment data, since yesterday's CPI data, we had 4 Fed speakers in here. 4, was it 4? I don't think they got Williams. Williams spoke as well and was equally kind of hawkish. So we had Barkin, Logan, and Harker, and we had Williams as well. Okay, all of them in here indicating higher for longer. Okay, the market is kind of pricing in higher now. Okay, the Fed last told us at the last dot plot 5.1. The market's now probably pricing in more like, if we go back to the CME tool, it's pricing in now here 500 to 5. Sorry, no, that's. If we go to June or July, 525 to 550. Okay, so it's pricing in more like 5.3, 5.4 as the terminal rate. Okay, at the peak rate. Okay, so it's starting to price in more. Okay, it could easily be higher than that. And there are some calling for. If I go to Deutsche Bank, this is out from today. Okay, Deutsche Bank rapid outlook is now increased its US terminal rate forecast to 5.6 from 5.1. Okay, so it's ratcheting it up. 2 extra 25 basis point hikes anticipated in June and July. Okay, so we're expecting it up, and that's what the market is expecting. So they're playing a bit of catch up, right? Remember though, we had Citigroup after, I think it was just after, it might have been before, but I think Citigroup in here. Citigroup, let me just type it in. I think it was just after the payroll data from the beginning of the week. Citigroup Fed funds projection. Let me see if we can find that. I guess 12.5 by May. Oh, they see here it is 6%. Yeah, so it was after. Okay, so we've got 2 in here. So Citigroup in here, prepare for the risk. Fed rate is 6%, so they're talking maybe as high as 6%. This came just after the payroll data. Okay, at the beginning of the month, and then in here, 5.5 by May. Okay, 5.5 by May from Citigroup CEO. And what we're pricing in for May, in here, by May we're only pricing in 5 to 525. Okay, so again, more aggressive, and Deutsche Bank slowly playing catch up as well. Okay, so all of this is showing that maybe even though since the dot plot chart, the Fed have been told us they're going to be going higher, the curve is starting to price that in, but the risk is we go even higher than this. And if we do get a more hawkish Fed coming through, if they do go to a higher terminal rate and for longer, then that's going to probably be damaging for stocks. So we need to really be watching Fed speakers. They're already lining this up for us. Okay, don't be surprised as them to continue to do so. We've only just had the last meeting, remember. We've got till the 22nd of March till the next meeting. So there's a lot of Fed speaking to be going on. So it's definitely something we need to be monitoring, because we could easily see the Fed ratcheting up their perception of where interest rates are going to the terminal peak, and then equally that there's going to be I think they really just need to start shouting about no rate cut. They're kind of telling us, but the curve's not listening. Okay, and that could be detrimental to stocks as well. So we need to be watching these. Okay, guys. Right, what else have I got for you? So futures parity drop with focus on rates. Yes, there is a focus on rates here, Fed speakers, etc. But incidentally, so we've also had, just going back to the data in here, if I switch to today, okay, we've had UK. Now, I know you guys are not trading UK markets, but inflation is a global phenomenon, right? It's no surprise that we're all up. Inflation rates all went up to I don't know, 8, 9, 10, 11%, depending on which economy you're in, and they're all starting to come back down. And they're all went up because of the same reasons, right? Energy and food because of Ukraine, etc. Post COVID reopening, supply chain issues. Okay, but then exacerbated by the war in Ukraine. So we did see some more favorable data. You can see in here, most of this is red. Red's negative, but it's not negative. It's actually positive because this is lower data than anticipated. So if you see in here, we have the CPI data was expected 10.3, 10.1. So keep in mind that we did have some favorable data. And if we go and see what the some articles in here. So we're seeing UK gilt's gone up. Okay. So remember, treasuries have sold off, been selling off. Okay. And we can take a look at that in here. I will show you where are we on the yield chart? Where's the yield chart? Here it is here. So here's the yield chart. There's the payroll number. Okay, here's the employment report at the beginning of February. Boom. This is up in yield. This is not the Treasury futures. This is the yield chart, okay, on the cash yield. So the cash yield been going up, and then look, yesterday chopped down and chopped back up again and pointing higher, still pointing up, okay, pointing up to higher yields. And we go and look at it on the, where am I in here? And I go and switch to the other tab and we look at the actual futures. Here's the 10-year note on the daily. Chopping yesterday. This is just the upside down version, right? So let's get rid of all these old tools in here. In here below, you can see downtrend definitely since the payroll. Here's the payroll day. Here's payroll. Here's employment. Okay, down. Big rejection of the upside. Look, came right off that 13-period exponential moving average on the daily. Okay, and pointing lower in here again today. So we're pointing to lower prices, which equals switching chart. Okay, higher yields. Okay, still pointing to higher yields. Compare this though then to what we've got coming through in here. We've got in here UK gilts rally, gone up in price, down in yields. Okay, because of this data, because of the US CPI data, and the pound gone lower. Yesterday, dollar strengthened. Okay, dollar strengthened because of the anticipation of a more hawkish Fed. Okay, if we go and take a look at what happened to the pound has actually fallen this morning because of a perception of falling inflation eases pressure on the Bank of England. Okay, so potentially a more dovish Bank of England. So getting a diversity in here and the CPI numbers in here, but there are only slight misses. Okay, so we've had basically slightly hotter in the US than anticipated, slightly cooler in the UK than anticipated. So some of this might just come out in the wash in the long run, right? Everything's still aiming the right way. Remember, these pressures, we're in a global world these days, right? So, inflation's all spiked higher in the same rate and it's coming down, and the central banks have all reacted in the same way in here. Okay, I just wanted to point that out. Now, going back to the calendar, we do have then another set of data in here. Now, retail sales, how's the market going to approach retail sales? Do we want a strong retail sales? Strong retail sales, right, means the economy is healthy, gives the Fed room to, and normally strong retail sales, good for stocks, right? Obvious, yeah? But strong retail sales, okay, gives the Fed, room, means a strong consumer, gives the Fed room to hike rates more, higher rates, bad for stocks, right? Weak retail sales means then, is that the economy not doing so well? Is it good so do we want weak retail sales? I think, again, what we really want is, retail sales to come in kind of in line, slightly better, slightly worse is okay. We don't want it to either extreme. We don't want it to be printing away from current levels. I would say, if anything, the market probably wants just a slightly weaker retail sales, but in line would be perfect for a rally for stocks. I think if retail sales are too high, I think, we could spike up and then come off, so just watch out for that. So we got that today. We also get, don't forget, then a 9:15 Eastern. So that's in just under 40 odd minutes in here. We've got the retail sales number now. Don't forget at 9:15, we get industrial production and manufacturing production, capacity utilization. Doesn't usually move markets too much in here. And then we get oil inventories. If you're trading the oil markets, watching out for that at 10:30 Eastern time. We get all that oil and gasoline data then. Okay, so watching out for that. What else do I have for you in here? We spoke about the gilts and sterling in reacting. European bourses are slightly up actually overnight in here. The CAC actually doing really well, up over 1% in here. The French index and US stock indices. Okay, we've got down in here, but they're not as much. I think this needs a refresh. Or it's delayed data, because we did dip initially and then saw a bounce, and maybe we're just still slightly down, but dip and a bounce in here on the overnight. Okay, let's go take a look at some of the charts. So, as I said it already in here, let's say it's actually trade on treasuries. For me, treasury is still pointing down. Big bearish outside day yesterday, a kind of rebound and failure this morning, still pointing down. So this is a 10-year note. I still think remains vulnerable in here. There's the spiky day yesterday in here. Tried to rebound, failing. For me, this is pointing lower for the 10-year. So yeah, looking vulnerable to back to yesterday's low and below. While I'm on this tab, I'm going to go through the oil market. So yes, we had a sell-off yesterday and then a rebound. Yes, we have a deeper sell-off and then another rebound. This stays slightly positive for me. I'm still kind of slightly positive on oil and going into the 15-minute chart. If you can look at this little counter trend line, so we did break this uptrend line, but then look, we broke the uptrend line through the data, chop, 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 and then we've been down and then rebounding. I would say now I'll be focusing in on this kind of counter trend line off the top. So if you're trading oil, looking at that, okay, and look, the market's flirting with that, breaking that as we're kind of speaking there. So for me, upside on oil, and let's take a look at gold while we're here. So still remaining very vulnerable in here, pushing lower again in here this morning. Real downsides for gold, and that's not being helped obviously by dollar strength on the back of a perception of a more hawkish Fed. So hawkish Fed, dollar strength equals gold weakness, and that looks still very vulnerable. Let's take a look at the stock indices. I think you're just looking at breakout parameters in here now. So you got the chop fest yesterday. Okay, so all that chop fest. Okay, I think you got these narrow overnight highs and lows. I think below now 41.19, it looks vulnerable. Back above 41.56.5, it looks more positive. That's on the S&P. I'd be simply waiting for the breakout of those parameters. In between, I think it's just noise. I mean, really, the topping pattern is still in place. Okay. But, I would be looking for a breakout of those parameters on the day trade. And it's a similar story, but the NASDAQ, it's coming off this trend line. It's repeatedly rebounding off the trend line. Repeatedly, look, doesn't want to close below that 13-period exponential moving average. A dip and a bounce in here this morning. So there is a resilience in there on the NASDAQ. And again, the NASDAQ breaking higher, this morning already. I think, though, you've got to wait for the back up to and through the highs. I don't think, now you can really go. If it gets below the overnight, okay, so 12,530 looks vulnerable. Up above 12,665 looks positive. Okay, in between there, I think it's just noise. So I think you're waiting for the triggers now, and go with the break, particularly if we get an impetus through retail sales. All right, guys, I'm going to wrap it up there. Any questions? Anything from anyone? Any questions? Nothing coming through. All right, guys, I'm going to wish you all a great trading day. Stay safe, take care. I'll be back with you tomorrow for heads up, by the way. Very unlikely there's going to be a webinar on Friday. Probably no webinar on Friday. So I'll be back with you tomorrow, Thursday, for the Bull versus Bear webinar. But probably no webinar on Friday. So but I'll remind you that again tomorrow. And we'll put that obviously in the forums and in the trading room. So probably no webinar on Friday as an early heads up. But watch out for a notice on that. All right, guys, have a good one. Take care. Bye.